This Friday sees the latest jobs report out of the US. And of course, right now, everyone's just concerned about what's happening in Iran. Nonetheless, we've seen strength in terms of the US dollar, weakness in terms of the likes of the Dow and some of the US equity markets. So the question mark is, what should we expect for this jobs report and how will it be able to impact those key markets? So let's take a look first and foremost at market expectations. This is according to Trading Economics. You can see payrolls expected to drop down from 130k down to 70k. That was an outlier. We're quite used to seeing figures below 100k nowadays, but that 130k really did shot the markets last time around and make people think maybe things aren't as bad as they seem to be. Now, unemployment at 4.3% expected to remain there. Same for the U6 metric. In terms of the average hourly earnings, expected to decline down to 3.6% from 3.7%. And as we can see here, the main drag that we've been seeing really comes in the form of government payrolls. Joe Biden, a lot more reliant on hiring in the government sector than Donald Trump. And that doesn't necessarily do him favors when it comes to the numbers. And you can see that the private sector is really where the job growth is at. 172 last time around, 85k expected this time around. And you can see in terms of the breakdown of exactly where the jobs are being created or not. You can see in terms of the right section compared to the left, sort of pre-Trump and with Trump, you can see that the one standout feature here is the over-reliance on education and healthcare, for sure. But also it's notable that that pink section, the government hiring, has gone from being a net positive each month to a net negative each month. So certainly it's not necessarily helping the figures, and we're probably going to see more of the same this time around. In terms of the unemployment rate, like I said, markets expecting it to remain steady. But nonetheless, you can see here in terms of US unemployment, despite the fact that, yes, it's been on the rise, don't let it get overblown because it's still very low. You can see it's at the kind of levels that we had in sort of 2016, 2017, and well below many of their peers. In terms of the rate of increase as well, very gradual in nature. The UK seeing a much steeper incline when it comes to unemployment and well below those at the top end here with the likes of Canada and the Euro area, both above 6% unemployment. One of the sort of ways that we can utilize alternate sort of metrics of job strength or weakness is to look at the likes of the quits and layoffs and the JOLTS job openings number. So the job openings figures have continued to fall, and that ratio between those that quit, remember, you probably quit if you feel quite confident you've got another job on the side, or you're laid off or discharged. That ratio kind of goes hand in hand with the job openings, and both of them also do generally trend alongside the unemployment rate. I've got that inverted in purple along the top, and you can see that that has been a much more gradual ascent rather than the sharp decline we're seeing for those other metrics. In terms of the data we've seen thus far this week, the latest ADP payrolls figure came in above expectations at 63k. In terms of the relationship between the non-farm payrolls and the headline figure, well, it's questionable at best. And you can see the differences between, or the differential between the headline payrolls figure and the ADP number along the bottom there. But certainly something worth noting as we head into Friday's report. Of course, recently, one of the big fears has really been the rise of energy prices, with nat gas in Europe in particular doubling over the course of 2 days. And then we've seen oil prices also on the rise, people calling for potentially $100 a barrel in terms of oil. Well, that has certainly dented sentiment around potential easing from the Federal Reserve. This is what's supposed to be Kevin Walsh's first meeting, the June 2026 meeting. Markets now pricing over a 60% chance that we see them pause. In the past, it was a base case scenario that they would cut at that first meeting for Walsh. It may not necessarily be the first because he needs to be ratified and put in. And they're saying that they should hold off until the DOJ case against Powell is finished. But nonetheless, support for easing has sort of dropped off, and that really comes around inflation expectations. Now, if we utilize the 2-year yield as a proxy for market expectations around the Federal Reserve, we can see here the decline that we've been looking at over the course of recent years leads to weakness in terms of the US dollar. So we've got it overlaid with the dollar index here. And so essentially, if we see data coming out that point towards additional easing, it should signal the potential for further weakness for the US dollar. But instead, over the course of the past few days, we've seen people fearful over a resurgence in inflation owing to the energy crisis in the Middle East. And that, of course, therefore leads the US dollar higher. And that's exactly what we have been seeing of late. So putting this in the context of Friday's jobs report, we have to say, well, if we see weak jobs data to the extent that we think it would force the hand of the Federal Reserve, that provides the basis for weakness for the US dollar. The flip side is if we see stronger jobs data, that essentially means that they can focus on what's happening on the inflation perspective, and that means that they're going to be more patient. And so if you look at it, the unemployment rate is already at very low levels. Unless we see a sharp jump in terms of unemployment, it's probably not going to move the needle in terms of Fed thinking. In terms of the payrolls figures, well, the ADP numbers already come in better than expected. Will it come in lower than markets are expecting? It possibly could, but it's a pretty low figure markets are expecting anyway. And certainly they are aware of the fact that the jobs market's not in a great position. So I don't necessarily know, unless you see a really sharp drop off, whether it's going to be enough to really force the hand. So if we see strong jobs data, it points towards a possibility of a break higher in terms of the US dollar index. If we do see a really weak jobs report, then yeah, maybe it could start to bring hopes of a rate cut in June back to the table, thus weakening the US dollar. And the flip side is that we've got the inverse correlation between the 2-year yield and the Dow. So I've inverted it. That blue line here is the same blue line that we had back here, except for upside down. There we go. And zoomed in a little bit, granted. And so we can see here that essentially the lower the 2-year yield goes, the higher we see the Dow moving. And so if we see data that points towards additional rate cuts from the Federal Reserve, that should benefit the Dow. But of course, that means that we're looking at a bad news is good news scenario. So essentially, oh, look, the US economy is in trouble, time to buy US stocks. It seems somewhat counterintuitive, and often it can be. So it's not a given that that's going to happen, but you can see the correlation that we've got here does point towards the idea that lower inflation in particular would lead us higher when it comes to the Dow. If additional rate cuts come at the expense of a sharp downturn in the economy, then that's somewhat different from the deterioration in terms of inflation. So different ways of looking at it and cutting up the data, really. So let's look at the chart. So this is the Dow. We can see that inverse relationship, which I can show you here. So let's just get rid of the 2-year and look at the chart itself. So we've got this ascending trend line coming into play here. Let me just go full screen. Get my ugly mug in the corner. So we've got this ascending trend line coming into play here. We've come beyond that, but we've come into the 61.8 fib. So that points towards a possibility of a bottom, but a lot of this really is tied into what's happening in terms of Iran. And ultimately, you could see a headline within the next hour that could see markets crash. You can see a headline that essentially means, oh, look, it's almost over, and suddenly everyone buys the dip. So it's quite difficult to say that just because the technicals look a certain way, that's exactly how it's going to play out. This is heavily news driven at the moment, and therefore you do have the high possibility of volatility. You can see on the hourly time frame though that we've got this swing high 490.64. If we break through that level, it does provide the basis for greater confidence that the bottom is in. But yeah, we've seen this sharp pop. Are we going to roll over again? Yeah, I think a lot of it's going to be sort of headline driven over the near term, but certainly part of those headlines will be the jobs report on Friday. So yeah, an interesting one at the moment. We've sort of come into a zone of support that in the past has represented a sort of buying opportunity when you come back towards this trend line. So that may be the case. But really, if we see signs that this conflict is going to roll on for, say, a month, that's detrimental for equities. If we see signs that this is going to be over in a few days, suddenly I think we'll be back at record highs in no time, because essentially everyone just buy the dip. And then finally, looking at the dollar index, like I said, we've seen the gains in the dollar index coming at the time that we see a pop in terms of the 2-year yield and rate expectations. There's the rise and there's the rise. And so this means if we expect to see additional rate cuts coming into play, it does benefit the likes of the US dollar index. That, of course, comes in a number of different ways. It can come through inflation. It can come through the likes of job weakness. And so if we do see that weak metric coming out in terms of the payrolls, for example, it could provide the basis for weakness for the US dollar index. But if we see stronger jobs data coming at a time where the Iran conflict continues to sort of rage on, and if we see higher energy prices as a result, that could provide the basis for a breakthrough 93.75 and crucially 94.61. Because if we break through that, all of a sudden you look at this monthly time frame and say, you know, maybe this is a ABC style retracement set within a wider uptrend and that the bulls are back into play now that we've broken through resistance, possibly. And certainly if you look at that relationship between what the US dollar did under Trump the first time around and where we are now, that signals the possibility of a stronger dollar from here on out. But inflation and the jobs market will play a very key role in those expectations. So look out for this zone of resistance. It has to hold. If it doesn't, it could signal a period of upside coming into play for the US dollar. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.